Welcome to another video by The Bottom Line. In this video, I want to show how I screen stocks and how the process helps me to reduce the number of stocks that I really have to look at on a particular day, month, or if it is a long term investment, then let's say over a few months. And what factors do I consider when I'm investing? So, any particular stock I pick, I spend close to 3 or 4 minutes at best to look at what the company does, what is going on with the financials, and where do I see this company in terms of certain parameters that I like to look at that have worked well for me, in my opinion, in terms of getting a good return over a significantly long period of time. There is obviously a query which generates the results for me. I can share that query in the comment section if required, but broadly, the query filters on a few parameters across the stock portfolio that is available in the Indian markets, and with that, I'm able to filter a lot of things out or filter a lot of companies out that just do not fit the bill for me in terms of investment style. So, if we quickly look at uh, the filter that I use, any company that has a market capitalization of more than 50, uh, any company that has an average return on capital employed in the past 5 years greater than 15, any company that has a sales growth of greater than 10. Debt to equity is very strict, it is less than 0.26, it's not even zero point 0.5. So I consider companies which are debt free. If the debt to equity is zero, that's, I think, the most ideal state of any organization. uh, the operating profit margin for the past 5 years is 15. Now this is again average, so a lot of companies will not qualify on this, or a lot of companies will, but we have to look into that particular stock and then decide what's going on. uh, I strictly maintain price to earning. Current price to earning of the stock is less than the industry's price to earning. This is especially when I'm trying to enter a new stock or analyzing a new company, which I believe I should always enter at a pricing that is cheap and exit at a pricing that is, slightly oversold in nature. So this adds a very important filter. And the last one is profit growth for the last 5 years is greater than 10. Again, this is an average. Most companies will fit, will not fit. Uh, this is one filter that you may or may not choose, which is, filter only those companies which have a September 2023 results available. But that's not always a parameter that I take into consideration, because quarterly results do matter, but it is very difficult to keep a track of every company every single quarter when the September results are out or any other December results are out. So without that filter, it brings me to a list of about 95 stocks. And if I look at the uh, aspects that I consider when I look at the list, is I look at, most important, what is the debt to equity, the 1 year return on this stock. So if this stock has been giving a negative return, that's something that I look at closely, because these are the stocks that I consider come at a cheaper value at this point. The P, the industry P, and what is the variance between the two. The greater the variance, the better it is in terms of valuation. ROC again is a filter, sales variance is a filter. Market cap doesn't matter that much, but it comes as a default list, and the CMP comes as a default list. So if I have to look at, let's say in today's example, I look at the top 3 stocks, decide what I believe should be a good company fundamentally or not for these 3 in the list, right? And we'll spend only a very little amount of time on each one of these, but I look at everything that I look at when I'm screening the stocks. So the first one in the list, which is Arkin Chemical, very quickly trying to understand what their business is. They have been creating marine chemical salt, bromine, and sulfate of potash, and that forms the broad business. So it is a chemical dominated company. In terms of the peer comparison, it's very important here that I see that the company is having a P ratio of 16 as compared to the industry average of 31. Look at Deepak Nitrite, Solar Industries, Pidilite, SRF, they're all well beyond the industry P of 31.71, which you will also see as a possible reason why most of these stocks in the upper quadrant are either going flat or they're not producing any new gains in the recent 6 or 8 months. You would also question that something is having a lower P than Archean Chemicals. So why are we choosing this one over Tata Chemicals? One of the most important reasons is market cap. I see Archean Chemical as a new and budding company, risky, but that's what will provide the rewards. And most important is the difference between the debt to equity. So Archean Chemical is lower in terms of the debt to equity ratio. If I look at the quarterly results and the OPMs around it, significantly good sales. I think the numbers are very consistent. If you look at the operating profit margin, very consistently, well in the range of 30 to 40, which is a very healthy OPM in the chemical industry. Profit before tax has been, deviating. That's because obviously these are quarterly earnings. But if we look down into the profit and loss for the year, again the OPM is well above 40 for the last 3 years. If we look at the net profit, the net profit has been growing. Very important to keep a watch on this. If I look at one of the key important numbers, you see the borrowings have significantly been reducing. That means they've been repaying their debt and relying more on equity money. The current borrowing structure that we have, there is no or little long-term debt. There is some short-term borrowings, and then there are lease liabilities, which obviously are, I would consider that as operating cost on any particular day. If I have to compare that with cash equivalents, then we have a cash equivalent of 58 crore. It's not much, but it is good enough to cover these costs at that point. I would want to see this increasing in the meanwhile, but as of now, that's fine. The cash flows, again, if you see everywhere, we have positive cash flows except for the year of 2020, which I do consider as an exceptional year or exception year because it was COVID hit and we did not have much that anyone could do. But every other year we have positive cash flows of very huge amounts, right? Almost double of what their investing cash flow is. So every year we are seeing free cash flows, and this is a very important factor when I consider that if some companies are profitable, then I want to see them, creating a good amount of cash flows. ROC is also a decent, significantly good. We don't have a lot of data here in inventory days, but that would be too much of an overkill to analyze. So if we look at it, this is a fundamentally good company with excellent debt to equity ratio and a valuation that is cheap. I will not comment on what are the right levels to buy this. It's up to the individual, and I'm also not trying to influence your decision to buy or sell this particular security. If I look at the second one, I believe we have gone through this much more in detail, but a very quick walkthrough. The first thing, this is a miscellaneous category, so this is a very unique business. Like I said, it transfers cash from one place to another, and that's what their business is. So they are lower in the miscellaneous category, but it doesn't matter as much on the P ratio because the business itself is a monopoly business. Uh, if we look at profit and loss for Radiant, it's a good, healthy, about 20% OPM every single year consistently. Borrowings almost nil on long term. Short term borrowings are there, but they are being covered by the cash equivalents here, which is 139, so almost 4 times of what the borrowings are. If you look at the cash flow, you might see that the difference here is very low, and that could be a concern. In such cases, what I generally do is then I open up the investing activity and see what's going on inside the investing activity. So if you see, actually out of the 73 crores, almost 69 crores is only investing items. So the actual investing or spend that is done for only 6 crores. So effectively there is a 68 crore free cash flow that is available with Radiant Cash. If you look at ROC, one of the best, above 40 ROC is really, really healthy in my opinion. And that's it. That also qualifies as a good fundamental stock, available at a very cheap valuation. If I look at Brightcom Group, again, I have not really looked at this stock before, but if we quickly understand, this is a ad tech and digital marketing company. It has software services, also some futuristic technologies. The product portfolio is the following products, and it has worked with all these band. If we look at the structure, it's a ad tech and digital marketing revenue. So the revenue structure of this particular is sale of services 93%, sale of software is 7. So sale of services was ad tech, advertisements that they do. So that's broadly the level. Now some things that are very important to look at is that SEBI ordered a forensic audit on this company, and the said forensic audit on this progress, and the final outcome of the investigation is yet to come by the time of certification. So there is a forensic audit that has happened on Brightcom Group. That is a big red flag for me. I would essentially just rule this company out immediately when I see that as a problem. But still, I'll go through quickly. It's categorized in IT software. The P ratio is very cheap. It may look like it's very cheap, but now you can figure out why it is cheap. There is a ongoing SEBI investigation on fraud analysis. If we look at the profit and loss, I don't see any big problems with profit and loss. We have a TTM, or rather, if we take 2023, we have a 29% OPM profit and loss. If we go down into the balance sheet, borrowings are nil. The other assets, we have significant amount of cash equivalents, around 1400 crores available in cash. Cash flows, if we look at it, there is a significant amount where this is 1 year, again exception year, but if you see positive cash flow, here is another positive cash flow, and every single year behind here is almost a positive cash flow except this one, but I'm pretty sure that would be a reason of investing around it. The ROC also is not one of the best, but it is significant above, just inching about 20 on an average, and that's a good ROC as well. Broadly, if we look at it, it's a good fundamental company. The only problem that I see are with two things. Generally, this is if we look at it, it's a ad tech business, right? And that's something I possibly do or do not understand. But this is a booming industry as of now. But a SEBI ongoing investigation is a critical concern. But apart from that, I don't see Brightcom Group to be in any kind of problem. I do also know that this is a very old company, but the stock has not moved just anywhere, and you can see the tip from this highs of 117 in December to 20 has all been due to that one event of SEBI ordering a forensic audit. So would I touch such an organization which is undergoing audit and I do not know what will be the outcome of that particular audit? I do not. So in my opinion, although this particular company is fundamentally strong, there is something that is really a big red flag about it, which stops me from analyzing any further beyond the SEBI order. So that's essentially how I have come across many companies and I have analyzed many companies. This is how I spend 3 or 4 minutes at best to try and find out if a particular company is even worth the time of analysis, or do I see some red flags upfront and uh, I try to address them. One of the few red flags that I've already removed is debt to equity ratio. Again, debt to equity ratio is not applicable to a banking stock. So in this 95 results that you see, you'll not see any banking stock. There is a different way to analyze banks. It's a more complex way. Maybe it's a topic for later. But if we see, that's how I'm looking at. So try out a few other stocks, maybe these 5 in the list, and try and understand how this analysis can be done in a more easier way. I hope this helps you one day in advance and to use your Sunday tomorrow more productively by analyzing companies that you like, you appreciate, and you find value in. Until I speak to you next time, uh, I wish you a very happy Diwali, good luck, and good investing. Bye bye.